Ken Long from Tortoise Capital with a review of the weekend trading plan for March 4th, 2012. We'll move from that into the daily trading plan and then look at some charts of interest for the VIX. There's a perfect storm of volatility has occurred in my view, so it's got my attention. Okay. Okay, to get started then, we're in bullish quiet conditions still. We're at 65 out of 100 on the annual range, which puts us in the high end of neutral based on a weekly RSI 14 reading. On a 10-day NDX, we're at 67 out of 100, so we're back into neutral. We had been overbought for most of last week. The price relative to the 200-day moving average and the slope of the 50-day moving average are both coded green and bullish, so that's very strong. ADX has pulled back from 40 to 37.7, so it's still strong, not as strong as it had been, and we'll see that the trendiness is starting to roll over a little bit. The bulls getting a little long in the tooth. ATR percentage at 0.83%, still under 1.0, so, rated as quiet. So bull quiet, market's neutral. We still want to be long on this in this market. The monthly rebalancing portfolios, the 26 ETF is holding the NASDAQ 100, financials, and Brazil. The 13 ETF is holding NASDAQ, U.S. mid caps, and U.S. large caps. Next reevaluation on or about 1 April. ETF 2. Theoretical exposure is still at 100%. The model portfolio is still at 100%. The only thing to do this weekend is to update stops in that system. Moving on. Quick review of the 13 and the 26 blended monthly portfolios. And you see I already talked about the strong ones. The weak still is Treasuries, Australia, Japan. And you can see ILF has moved up even above U.S. small caps, so that stealth move in Latin America and Brazil is continuing. You can also see that in the 26 ETF portfolio with Brazil and Latin America near the top. At the bottom, gold, Swiss franc, agriculture, and then the short-term treasuries and blended commodities. So all the commodity-based measures are still at the bottom. So this is still a risk-on market, risk-on trade, with centered in the U.S. and then with growth potential in emerging markets, specifically Latin America. Next up, we're going to look at the market health check. The vertical blue lines are 10, 20, and 30 days of look back. The solid black line in the center is the 30-day regression line that's offset 1 day. The outer black lines represent the regression channel formed by the maximum excursion from the regression line during the look-back period, which happened at the end of January here. I've added a little refinement to the chart so it's easier to see what we're talking about here. The dotted green line is an extension of the upper regression channel. Dotted red line is an extension of the lower channel. Dotted black line in the middle is the regression line itself. It takes a close outside of the red or green to suggest to us that something materially different just happened than whatever is going on. See, the logic is there's something going on in the market that is producing this kind of price action. And as long as it stays within this regression channel, then today was just more of the same. But if you get a close outside of that regression channel, then we can say, oh, something just changed in the world. And so I've just shown by extension where those channel prices are would be for one more day. The horizontal red lines represent previous support levels that the market has held. The black boxes represent a 5 and a 10% pullback from the swing high. Right now we're resting on that swing high at 137. And you can almost see price is pulling back and below the regression line. It's now riding the 10-period moving average. So it's been fairly stationary in the last 10 days. So a lot of this growth that we got early in the move is kind of tapering off, and that is reflected in the decline of the ADX. It's hard to get it above 40 and hold it above 40. You can see that it went from about 12 on the 1st of January up to a high of about 40 at the blue circle, and now it's starting to degrade slowly. That's just because it's hard to maintain this kind of upward pressure on an instrument that large. You can see the 10-period moving average is the green line, the red is the 50, and the 200 is the boundary of that shaded blue area. And you can see all those moving averages and price are still pulling away from the 200, which is relatively slow to change. PPO, which is the difference between the 10 and the 20-period moving average on a percentage basis, you can see that is still declining, and that's just because both the 10 and the 20 are parallel lines just going up right now, and it's hard to maintain that upward slope, and that's the reason the slope indicator is also kind of flattening out from its peak. You see it got an awful lot better at the end of last year and in January as the market came out of the ocean here. But now that it's just kind of marching straight forward, it's hard to maintain that upward growth, and that's why those two indicators are rolling over. We just came out of the oversold conditions here. We've done that a couple of times since 1 January. Every time it was followed by another burst of buying. So that's still the expected case. The pullback was not very significant. It only just broke out of overbought, and it's minus 32 on Williams %R. So we have basically a quiet bull that just keeps marching northward, and the expected path for him to take is to stay within that regression channel and keep going. If we get a close above 140, that will really be significant. There's not been much evidence of panic selling. Sometimes little spikes intraday feel like it for a day trader, but when you take a look at the size of the ranges on a daily basis, there really has not been any panic selling, which is what I'll cover when we get to the charts of interest. I want to have a few things to say about it there. Moving on. The ETF2 database, the top 10 regions, they're all on buy signals, so we're still at 100% invested. SPY at 71 is still better than EFA, which is the rest of the world, at 64. So it's the U.S. over the rest of the world. And then inside the U.S., it's the NASDAQ at 76, then SPY at 71, then mid caps, and then small caps. So NASDAQ and the U.S. large caps are the two strongest. Two weakest are EFA and European 350. Moving on. World market model next. U.S. still well above average everywhere, and then the NASDAQ is the upper right-hand corner at 83 is the strength. In the green. The other equity that is in the green is Brazil. So you can see Brazil, Mexico, and Latin America are all above average, with Brazil especially leading the way. The usual winners in Asia continue to lead. Hong Kong, Malaysia, Singapore, Taiwan. India, China, Australia lagging. Europe decidedly weaker. Spain is in the weakest position. It's still the risk-on trade when you take a look at the business sectors. It's tech, industrials, finance, and materials doing well. Only the energy sector showed a little bit of a crack this week, dropping back into the yellow, along with the other defensive plays of discretionary, healthcare, utilities, and staples. Among the asset classes, there was some profit-taking in gold and silver and a reaction to Bernanke's speech. But U.S. real estate and oil still continue to do pretty well. Moving on. Next up is the top symbols of the ETF database. And we have the same winners as we had last week: home construction, biotechs, regional banks. The NASDAQ has moved up into the green. Retail stays there. Information technology, the technology spider, retail holders. This weakness here when you see things that are in the green but have turned to red in the strength rating, that's a sign. Remember, the strength rating is the first column out of the three subordinate measures that changes. So the ones that are in red are the ones where growth or liquidity is pulling out of them. So it's retail is getting weaker, bonds, energy sector, treasuries, and the ones that are green and green still are in the strongest position. So home builders, biotech, and all the technology names are still in good shape. So that's how we read that one. Moving on. Same strategy, but now looking at the Dow 30. Excuse me. Wait for that to come up on your screen. There we go. Now what I've got, this is sorted by the pure relative strength here, that 3 and 6 month look back. So the strongest ones here: Bank of America, Home Depot, Microsoft, Disney, Caterpillar, J.P. Morgan at the bottom, Hewlett Packard, Alcoa, Johnson & Johnson, Coke. Only Walmart and Hewlett Packard remain on are below their 4 month moving average. Everything else is still a raging buy in the Dow. Moving on. Looking at ETF liquidity, I just want to highlight that the VIX has increased its ATR percentage now on a daily basis up to 6 3/4. So it's starting to get some intraday plays. Now, the overnight holding has not been as rewarding, but the first thing that we're starting to see is that people willing to play the VIX are willing to play it intraday, but not hold it overnight. If we start getting some system shocks, then you'll see swing trading become a possibility in the VIX, and more money will go in there. But it's got an intraday ATR percentage of 6.78%, which is pretty remarkable. Moving on. This is a hint of a chart to come. And this is the new report that I added last week to the weekly, and it represents a 5-year. The little chart is a 5-year look back on SPY's 30-day standard deviation expressed as a percentage. So it takes the standard deviation price of the last 30 days, expresses that as a percentage, and then finds out where in the time series that fits. And what I want you to notice is that in the last 5 years, there have been, 3, maybe 3.5 extreme volatility spikes where that standard deviation shot up quickly to, almost 2%, in one case over 3%. This was 2008, 2009 here. And then volatility slowly comes out of the market as fear slowly recedes. So it goes from complacency to abject terror pretty darn quickly. I want you to notice that in every case, those big volatility spikes were preceded by periods of abnormal quietude. You can see that here, here, and here. And then now this is where we are. This zooms in on the last 180 days. The black line is actually a 10-day moving average of that ATR percentage. And where we are right now at about 0.7 is extremely quiet. So I guess my point there was, yeah, history doesn't repeat itself, but it often rhymes. There's a lot of quiet has been packed into this bullish run up to 137, 138 in SPY. We're back to the heights prior to the 2008-2009 sell-offs, and volatility is extremely quiet on a historical basis. And as we know, it'll stay that way until it changes. When it changes, it tends to change conditions pretty darn quickly, as you can see by these spikes. Those are the spikes that kind of invalidate everybody's long-term models of risk measurement, because it changes the market state so quickly. Moving on, we're going to take a look at, we're going to shift over to the daily report next. Why this is not allowing me to show that to you. I may have to reopen that file. Please stand by. Okay, that should come up on your screen here in a second. So back to the daily now, and I'm not going to read the row again to you, but what was inside a gap statistic, we're going to take a look at the last 30 days, and 15 times the market has gapped down in the last 30 days. One of those times, the gap down was followed by a short additional sell-off of an additional 0.17%, so it closed below the open. 14 out of 15 times when the market's gapped down, it has closed higher for an average follow-through of 0.47. The gaps up, though, have been evenly split. It's also gapped up 15 times. 8 times it's reversed to close lower for an average follow-through of minus 0.36. And 7 times the gap up has been followed by an additional gain to close higher with an average follow-through of 0.30. So those are really small moves on follow-throughs. That's not surprising given the quiet nature of this market. But as you can see, there still is a considerable difference in market behavior based on whether it gaps down or gaps up. As you can see, we came out of overbought conditions here on Friday. No signals in the overreaction or channeling. You can see just how much volatility has come out of this market based on ATR percentage. This is a look at the last 100 days. It's gone from 3% down to about 0.83%. So fully 3/4 of the market's volatility has evaporated in the last 100 days. And now on the ADX, you can see that just starting to roll over. It came up and briefly touched 40 and is rolling down. Key winners in the 10-day max pain or min pain: American Express, J.P. Morgan, Chevron, ExxonMobil, Procter & Gamble. 10-day max pain, in a position to rebound from suffering, if you will: Hewlett Packard, Walmart, Bank of America, Home Depot, Alcoa. And among the ETF 100, the VIX, natural gas, and then the gold miners. I don't recognize those two in the middle. Short-term pattern setups: we have 551Ws in IYR, which is U.S. real estate and U.S. small caps, and also an Intel as a large cap. We have a 5DD in Hewlett Packard. Triple screen in real estate and Alcoa, and channeling signals in Walmart, Kraft, and Travelers. The auto framer finds 2-to-1 mechanical entries available for VIX, Hewlett Packard, and Walmart, and those also have some pattern trades, some swing trades associated with them. So those are reasonable trades to follow up on. Moving on. Looking at the Dow tactical summary. Lots of dojis to choose from, and here's the 3 channeling signals: Walmart, Kraft, and Travelers, the 5DD and Hewlett Packard, the triple screen in Alcoa, which is also a doji, and the 551W in Intel. Hewlett Packard and Walmart are offering better than 5-to-1 on reward to risk ratio using the mechanical setup. So you can see what sets that up is this horrible sell-off in Hewlett Packard and Walmart. I like Walmart because even though it lost on Friday, it was not an exceptional loser compared to Hewlett Packard, Boeing, and Alcoa and GE. So it only lost minus 0.6. So that's one to be interested in. Walmart is on sale. Shifting over to the ETFs. Only a handful of dojis. Let me let it come up on your screen first. There's only a handful of dojis to choose from. Treasuries, Brazil, energy, and silver. Triple screen in U.S. real estate, which is also a 551W, and a 551W in the small caps. And then the VIX offers a 2-to-1 reward to risk. What I find interesting on the VIX is that it closed a one-day gain here, and you can see just how horribly it's been beaten down as all that volatility in the market evaporated over the last 100 days. You can see, like over a 3-month period, the VIX is down 46%. So that's quite a pullback. But when we look at the VIX time series charts, we're going to see what I think are some potential trades setting up. Moving on. Looking at the market mosaic next, the regression line still long and strong here. The thin black line is the 10-period moving average. Now you can barely get a knife blade in between them. You can see that that's still holding up almost a full standard deviation above the average. And this is what that looks like over the last 180 days. So we've kind of leveled off in this period where it leveled off before. This was the August sell-off in here. Oh, correction, this is the August sell-off, this big gap down. And you can see the percent stretch relative to the 200-day moving average has now gone 1.5 standard deviations above the 6-month average, and it has cleared the last spike we had, this was about June or July of last year, just prior to this August That's the August sell-off here. That corresponded with this change in market shape. Now, what I want you to notice is that when the slope got 1, 2, 3 standard deviations worse, it went from just about 1 standard deviation up to more than 2 standard deviations down. That corresponded in a rapid 15, almost 20% sell-off in the market in about 10 days. And so that kind of a move is still lurking out there, and you can see the size of the previous sell-offs when the market has stabilized. It couldn't push any higher. So I'm saying that's always a potential. Looking at the frogs, still quite a few are above the critical 3.0 range, including mid caps and small caps, U.S. real estates, Disney, agriculture. I like that Alcoa is up here near the top. Moving on. A shift. Actually, I want to move right to the charts of interest now. The other data is in there for you to review if you like. But I want to talk about tactical trading in the VIX. Okay, so this is one way to measure relative volatility in the market, and that's just the standard deviation of price over time. But there's another way to do it, and that's with the ATR percentage. And that's what I want to show you here. Okay. All right, so what I have here is 4 different time frames. But using a standard setup, which is that what I've been using lately, that regression line crossover, or the simplified price. On the right-hand side, you see this is my tactical screen. This is a 3-minute, and it looks at 1 day's worth of data. This happens to be Friday. Friday's trade was when the VIX came into this price region and chopped around and then left the station. There was a reasonable trade available here intraday from this support level near 24.05, and then we were able to cash that up around 24.5 for a couple R on a 25-cent initial stop, and the stop was below this support level. But 24 is the area that I want you to notice, and I want you to notice this. This move here in the last half of the day. Now, if we shift up one time frame, now we'll take a look at the VIX with the same setups. The black lines to the 30-period regression, blue lines to 10-period regression. The volume-weighted average price is still the purple dots. The Bollinger Band is still a 30-period look back with plus or minus 1 Bollinger Band region marked off. And each one of these vertical lines represents a day. So this is 4 weeks or 20 days on hourly dots. And this afternoon move here that I'm highlighting now corresponds to this afternoon move here. And what I want you to notice is that over the last 4 weeks, the VIX has been finding support down here around 24. And the last time it surged, it went from 24-ish to right around 25, so about a 4% move. And we got just a little taste of that on Friday. But within the last 4 weeks, this thing has been up around 28.5. And so while this little move right here intraday represents a 2R move going from 24 to 24.5, we're talking about a move that with a support level at 24 could get to 26.5, where you see this previous resistance, and then 28 pretty quickly. It gets up that far that fast very quickly when volatility changes, and when people are in a position to start being concerned about protecting their portfolio and hedging it with the VIX or hedging it with options. That's when you see VIX price spikes. Now, so we're going to go from 3-minute chart to the left. One period is hourly charts for 4 weeks. The next one is 2 years with, I'm sorry, this is daily for 3 months, pardon me. So within the last 3 months, the VIX was at as high as 48 and as low as 24. So now you can see this little spike here, which is the first significant move away from this downward trend. We've had one significant move away from, let me restate this. When the blue and the black line together leave the Bollinger Band region, I'm calling that the beginning of trending behavior. And so the real strong trend in declining volatility is kind of confirmed right here when the VIX is at about 40, and then both of those things start going down together well outside of the blue. Now, when we get the first serious move against that is when the VIX moved from 24 up to the mean at about 27. And remember, when we have those counter trend rallies, the target is always kind of the mean, and you can see why. And it's only recently, in the last day or so, that the 30-period regression line has rolled over and moved back into the Bollinger Band region. And now both of them, both the blue and the black line, are hovering down here around 24.5, or while the prices are around 24.30, right at the lower region of the Bollinger Band. And to me, that looks like one massive intermediate term trend where volatility has come out, and we've had one warning spike that goes the other way, where it went from 24 to 28, which is a 15% move in about 4 sessions. That's each of these little purple dots is a volume-weighted average price for the VIX on one day. And so you can see how it went from 24 to 28 in 1, 2, 3, 4 days of travel. That turns out to be the last time we had the live trading workshop here in Kansas City. We were able to turn that into like an 11-hour trade intraday on a Friday, as I believe people are starting to lock in their portfolio gains by buying options, which drives up the volatility, which drives up the VIX. So now we're looking at 24 was an important support level on a daily basis, on an hourly basis, and on a 3-minute basis. On a daily basis, the range is from 24 to 48, so a double. And now we'll go up to the last one where we're taking a look at a weekly chart for 2 years. And once again, we find that 24-ish price level is significant. The last big spike on a weekly basis, and this was the August move, it went from 24-ish to 50. That spike there is the same spike that you see just on the tail end of this of the daily chart. And that move was preceded by an extended period of time down here around 24 when all the volatility had come out. On a weekly basis, though, we're talking about a range over the last 2 years, an instrument that's traded between 24 and 140. I'm not saying it's going to go that high. I'm not saying anything like that. What I'm saying is that when that volatility changes, it changes in a hurry once fear comes into the market. And so this looked to me like a perfect storm of a trade on Friday, where I had on a 3-minute basis, an hourly basis, a daily basis, and a weekly basis, a well-defined support level around 24, and then a breakout from that region. Now, I decided to take this as a swing trade with a turbo component. And so what I ended up doing was I had decided if I can buy this about 24, which I did, and with a dollar stop, I'm well outside of the intraday noise. I'm willing to hold this on a swing basis with a $1 stop. And so now what I can do is intraday, my actual stop is about 20 cents or 25 cents. And so my intraday turbo position can be 4 times as large as the swing trade because my stop is 4 times as small. So what I'm able to do is take that intraday trade, capture 2R here, cash 3/4 of the position, and then use that money as the risk capital to fund the overnight trade with market's money, but at 1/4 of the position size that I had on during the day. Now, if we get any kind of news event, well, no, we haven't, but if we'd have gotten any kind of news event over the weekend, then it's possible to see these large gaps, like in this case over here on when you look at the daily, you're looking at a $2.50 gap in my favor if that swing trade had come through. So that's a case where we can use this idea of core position, which is based off of hourly swings, or even a daily position trade, or even a longer term intermediate position trade. I think entries around 24 with momentum are a relatively low risk idea, and that depending on what time frame and overnight risk you're willing to tolerate, you can have a more or less wider stop, and then you can trade this intraday tactically or over the longer periods of time as a conventional swing trade. But I want to demonstrate how I think the VIX is at a position where a lot of different support levels for different time frames are all coming together to set up a low risk trade based on volatility. Now to shift over to what that actual trade, the tactical trade, looked like. Let me see if I can pull that rascal up. Yeah, this was the chart that was in my mind as I was framing it up on Friday. And what I've rendered this down now to just the 3-minute chart, and then 4 weeks worth of 60-minute chart. Once it gets a little bit bigger, you can see it here. So the first thing I was looking at was treating this as was there a swing trade available in here? And in my view, there was. We were down here. It was in this choppy area intraday, and I said, let me just get a quick check. I remembered 24 was important when we looked last week at the Renko charts for the VIX. That 24 was sort of the lower limit. So I knew 24 was a reasonable support level. And when I framed, and so the vertical blue line is where I'm interested in it as a swing. And if I can buy it around 24, that's the green line, with about $1 stop, that gives me protection against the lows of the last 4 weeks. That's a $1 stop. Then I could my first reasonable target is the far side of the Bollinger Band, which also corresponds with this little cluster of price action around 25. And then the next center of mass of resistance levels going back is about 26.5. And then I looked at this cluster. That's kind of interesting. Those are the bottom and the top of the Bollinger Bands on the last bend of the river, if you will. But I was looking really at 26.5, 28-ish, and then almost 29 or 28.75. All of those I see as reasonable targets within this 4-week time frame. And so it would not surprise me to see the VIX get that high over the next 4 weeks. And so I wanted to initiate a swing trade with a relatively wide stop for me, which is $1. And I was able to time that with some intraday choppy price action here, where it looked to me like the VIX was in this, I'm going to call that a sideways quiet channel. It's only this is a 5 cent or 10 cent band of price right in here in the yellow. And so when it broke out of the Bollinger Band pinch, I was willing to buy this at 24.05 with a 25-cent initial stop. Even though this reflects, that's only 10 cents, but I just have a hard time using a 10-cent stop on the VIX because it moves so quickly. So I just used a 25-cent stop, which was well outside of the noise and well below the low of the day, and was able to cash that later at 24.40. There were other moments here and here where that same trade to cash at 24.35 would have been available for 1 hour. So this turned out to be about 1.5 hours now that I look at it. if I'd had the nerve to play a 10-cent stop or even a 15-cent stop, then that could become, 2.5, 3, or even a 4-hour trade. But that's pretty tight on the VIX. So I just want to show a tactical trade intraday, and then how that connects to a swing trade, and then to the larger idea of the VIX being in a posture for a setup to make a lot of people some money if there's any kind of fear. Let's see. Lisa asked me what made me hold it through all those other crossovers the other way and return to me. Well, part of it was the fact that I used a 25-cent stop, which was it's as well off the chart. I mean, 24.05. The initial stop is down here, another 10 cents below the bottom of the chart, and so it never was ever really in a position to threaten me. And besides, what I'm really trying to do is just get a good entry intraday on a swing trade. I'm willing to have a $1 swing trade stop on this one, and so it never even got close to the swing trade. I mean, it never really looked back. And then on the swing, if you look over here on the swing trade, all it did was just go up. A very smooth move up. And so I used a tactical entry on the 3 minutes, and then a wider than usual stop on the intraday trade. But it was really as the initial entry into the swing trade, and all I was looking for was an opportunity to sell off 3/4 of that position so that I could hold 1/4 of my initial position overnight. So that stuff was really I was not even really looking at the 3-minute chart on it, so that those didn't really concern me. Okay, so that's everything I wanted to cover tonight. And there's been a lot of interest in the home study courses, so enough interest to convince me to do it. And I actually started recording or editing some of the last live trading workshop to get just the highest quality trading lessons out of that, and cut out some of the silence in the middle. So I think that's going to probably render it down to about probably 8 hours of good video material. It's about 40 hours of video, and I think there's probably about 8 hours of really good stuff in there. So that's going to be the basis of the live trading, best of the live trading workshop DVD. So I'll keep you posted on that as we go. So pending any other questions, that's all the news here from Kansas. And I see Mark is on the. Hey, Mark, there was a guy over in the Philippines who has the TradeStation bundles, and I was wondering if I could give him your address. He had a couple questions about how to get started with it, and so I'm going to probably send you an email on that one. I appreciate that. Yeah, you should be getting a letter from us here pretty shortly too. So thanks to everyone, and yeah, Lisa, I'll send you the 331 rules. I'll do that this evening. So take good care, and we'll see you guys on the objective.